Welcome to this explainer. Today, we're putting on our detective hats to decode one of the most powerful, yet honestly frequently misunderstood signals in all of technical analysis, the hammer candlestick. You see, whenever there's a major shift in the market, it always leaves behind clues. So we're going to look incredibly closely at the physical evidence left behind on the charts to understand exactly what the market is telling us and how we can actually use that data to our advantage. So let's just get right into it. How often do you find yourself completely stuck, wondering if you're brilliantly catching the market bottom or accidentally buying the top right before the floor totally caves in? It's a wildly common frustration. You spot a shape on the chart, you jump in, and immediately the market violently moves against you. Well, today, we're going to fix that by removing the guesswork entirely. To do that, we've got a strict 5-step playbook. We're covering the hammer structure, why the lower wick matters more than the color, how to spot the tricky lookalikes, the crucial role of volume and support, and finally, exactly how to execute your trade and set your stop loss. Alright, Section 1, the anatomy of a reversal. Let's start at the micro level and examine the actual structure of the hammer candle itself. A proper hammer has some pretty strict physical rules. It's definitely not just any random candle with a wick. You need a small, real body sitting right near the very top of the trading range with little to literally no upper wick at all. And here's the kicker. That long lower wick, it needs to be at least twice the length of the body. Sometimes it's even 3 times as long. Oh, and the absolute non-negotiable rule here, it absolutely must appear after a clear downtrend. Without that prior drop in price, the whole pattern is completely meaningless. Now, I really want you to focus on that lower wick. In charting, wicks aren't just arbitrary lines drawn on a screen, right? They tell a very specific story about human emotion. This lower wick is basically the literal footprint of a brutal psychological battle. It tells us that sellers came in hot, aggressively pushing the price down early in the session and creating widespread panic. But then, right before the close, buyers stepped up with massive force, absorbing all that heavy selling pressure and totally rejecting those lower prices. Which leads us perfectly into Section 2, Psychology over Pigment, why that lower wick is actually way more important than the candle's color. This is a huge psychological realization, and honestly, it trips up so many beginners who get way too obsessed with the visuals. You're going to see green hammers, and you're going to see red hammers. Now sure, a green hammer is technically a bit stronger, because buyers actually managed to close the price higher than the open. But listen, a red hammer is still 100% valid. Even if the body is red, meaning the net sentiment for the day was slightly negative. That massive lower wick proves the exact same bullish tug-of-war happened right at the bottom. As this beautifully illustrates, that long lower wick is just indisputable proof that buyers absorbed the hit and are now gearing up to take control of the momentum. That absolute rejection of the lows is really the only thing that matters here, not whether the pigment of the candle body is red or green. Okay, moving on to Section 3, the suspect lineup. It's time to distinguish our real target from the fakes. You really gotta be careful here, because our hammer has some highly dangerous twins lurking on the charts, and they mean very different things. Take the hanging man, for instance. Visually, it looks practically identical to the hammer. Small body, super long lower wick. But context changes everything. If you see that exact same shape at the top of an uptrend, that's a hanging man. And that is a bearish trap, hinting that buyers are suddenly losing steam and sellers are starting to successfully test the waters. Then you've got the inverted hammer. Now this one does appear in a downtrend, just like our standard hammer, but it's completely flipped upside down. That long upper wick shows buyers tried really hard to push the price up, but just got slammed by overwhelming resistance. So it is still a potential bullish signal, but it's a much weaker one. You definitely want to wait for solid confirmation before even thinking about trading an inverted hammer. Let's jump over to Section 4. Context is king. Let's look at the volume and support we need to back up our theory. Because, let's be real, a shape is just a shape without the context. You need corroborating evidence. The biggest piece of evidence, volume. Volume is literally the fuel for price movement. When you spot a hammer, you really want to see a volume spike of about 1.5 to 2 times the average. That kind of high-volume hammer tells you that massive institutional money, the big banks and funds, are actually stepping in to support this reversal. If you see a hammer on super low volume, yeah, that's a major red flag showing zero market conviction. Furthermore, the most reliable hammers, they never just float around in the middle of nowhere. You want to see them strike exactly on major support zones. We're talking previous swing lows, major 50-day or 200-day moving averages, key Fibonacci levels that act as hidden mathematical floors, or even when the RSI is sitting deeply oversold below 30, meaning the selling is finally exhausted. When you combine the hammer shape with those levels, that's when you have true high probability confluence. Finally, Section 5. Executing the playbook. Setting your entries and your stop losses. So, we're moving from theory to strict action. You found the hammer, the volume looks great, it's sitting right on support. Now what? Rule number 1, never ever jump the gun. You must wait for the very next candle to close higher as your confirmation that buyers are actually following through. Once you get that, you enter your long trade right above the high of the hammer candle, and the second you're in, you place your stop loss strictly below the hammer's lower wick to protect your capital. When it comes to taking profits, you should always be targeting a minimum risk to reward ratio of 1 to 2. Basically, if your stop loss is risking $100, your target needs to be set to make at least 200. Just look for the next logical resistance level or a previous swing high on the chart to confidently lock in those gains. And we need to talk about why that stop loss placement is completely non-negotiable. The very bottom of that wick is the ultimate line in the sand for buyers. If the price breaks below that point, it means the buyers completely failed, the heavy selling pressure has returned, and the entire psychological reversal setup is just totally invalidated. You've got to cut the trade right there, no emotions attached. So, now that you've got the complete detective's playbook, I want to leave you with a question. The next time you spot a hammer shape on your chart, are you going to just blindly jump in hoping for a reversal? Or are you going to wait for the volume, the support, and the confirmation to actually prove the case? The difference between the two is literally the difference between just guessing and truly understanding the market. Keep observing, stay disciplined, and I'll catch you in the next explainer.